Welcome to Iron Financial. We're here to help you forge a stronger portfolio and cut right through the market weakness. Today, we've got CrowdStrike's latest earnings report on the table, and we are putting it under some extreme pressure. After those numbers dropped, the stock went on a pretty wild ride, and honestly, the big question echoing all over Wall Street is simple. Is this cybersecurity giant a true financial fortress built to withstand anything? Or is it just a house of cards waiting for the first stiff breeze to come along? Look, we're not here to just read you the headlines. We are here to run a full-blown structural stress test. Let's get to work. Okay, so here's our plan of attack, our analytical blueprint for today's breakdown. First, we're going to start with the initial shockwave, what we're calling the financial quake. Then, we'll take a look at the glossy exterior, the headline numbers that everyone sees. But after that, the real work starts. We're going to test the foundation, looking at the core metrics that are actually holding this whole thing up. From there, we'll inspect the scaffolding for future growth, bring in some heavy-duty AI-driven analysis to really quantify the risks, and then finally, we'll deliver our iron verdict. Think of it as a step-by-step architectural inspection of the entire company. Right, and before we get into all the nuts and bolts, let's just set the stage for a minute. The second these earnings numbers hit the wire, it was like a seismic event. The stock started moving, analysts were scrambling to update their models, and investors were left sitting there just trying to figure out what it all meant. It created this immediate conflict, this tension in the market story. Because on one hand, you've got a company posting what on the surface looks like a really solid beat, but on the other hand, you have a valuation that is priced for absolute total perfection. So it's the aftershocks from that collision that we're really digging into today. And that really brings us right to the core conflict, doesn't it? This is the fundamental question we have to answer here. Did this earnings report just add another layer of reinforced steel to the framework of a company that's building the future of cybersecurity? Or did it maybe expose the fact that this stock is just a glittering skyscraper built on a foundation that might not be nearly as solid as all the bulls want you to believe? We have to figure out if this is real, durable, long-lasting strength, or if it's just market hype. That's the test. All right, let's get out of the market noise and into the hard data. Every big architectural project, it starts with a blueprint, right? An impressive drawing that's designed to get everyone excited and inspire confidence. Well, in the world of finance, that blueprint is the headline numbers, the top-line revenue, and the bottom-line earnings. This is the very first thing investors look at. And I gotta say, on the surface, CrowdStrike's blueprint looks absolutely formidable. Let's break it down. So, the first thing that just jumps right off the page here is the consistency. We're looking at total revenue coming in at over $1.3 billion. That's a clean 23% jump from the same time last year. That is strong, no two ways about it. But the really crucial number here is the line right below it, subscription revenue. It's also up 23%. And look, it makes up almost all of their sales. This is not a one-time thing like selling a piece of hardware. This is the good stuff, high margin, sticky, recurring revenue. You see, this is the very bedrock of a modern software as a service, or SaaS, powerhouse. It tells you that customers aren't just buying once, they're staying, and they're probably buying even more over time. This is the first load-bearing wall we're testing, and from where I'm standing, it looks like solid, reinforced concrete. But listen, top-line growth is only ever half the story. A company can grow and grow and grow itself right into the ground if it's not profitable. That is exactly why we look at earnings per share, or EPS. And this, my friends, is the second major pillar supporting their whole financial structure. The street was expecting $1.10, CrowdStrike came in and delivered $1.12. Now, it's not a massive blowout beat, but a beat is a beat, and it signals discipline. It tells you that the management team isn't just chasing growth at any and all costs. They're actually converting that powerful revenue engine into real, hard profit. This is what operational efficiency looks like when you put it on a chart. Okay, hold on a second. The blueprint looks good. The artist rendering is impressive. I get it. I really do. But we're Iron Financial. We don't just stand back and admire the glossy pictures. It is time to put on the hard hats, get down into the foundation, and do some real stress testing. We need to see if the metrics that are hiding underneath this beautiful facade are truly load-bearing. Is it all solid concrete and rebar down there, or did somebody mix a little too much sand into the concrete? Couldn't agree more. And the very first test we always run is on net new annual recurring revenue, or ARR. Let's be perfectly clear about this. For a subscription business like CrowdStrike, this metric is literally everything. It is the lifeblood. We're not just talking about total revenue, we're talking about the momentum of that revenue. This number tells us exactly how quickly they're adding new business, upselling their existing clients, and, crucially, how well they're holding on to them. A weak net new ARR number is always the earliest sign of a crack in the foundation. And this number right here, this is where the bulls get all their strength. You have to understand the context for these recent Q4 numbers. And to do that, you have to look at the incredible momentum that was building just before it. In the previous quarter, Q3, net new ARR grew by an explosive 73% year over year. That is a hero statistic. It showed an unbelievable acceleration in getting new customers and expanding business with old ones right as they headed into the end of the year. This is the kind of number that suggests their market penetration isn't just growing steadily, it's actually picking up speed. This metric set the entire stage for a strong Q4 print, and it proves that the underlying demand engine is just firing on all cylinders. This is rock solid. And you know, that ARR growth wasn't just some number on paper. It translated directly into hard cash. Again, looking back at Q3, the company generated a record $296 million in free cash flow. This isn't some fuzzy accounting gimmick or a paper profit. No, this is physical cash generated by the business after all the operating expenses and capital expenditures are paid for. It proves the business model isn't just profitable, it's highly efficient and completely self-sustaining. This is the fuel for R&D, for acquisitions, for everything. A business gushing cash like this has incredible flexibility and a ton of durability. So next, let's talk efficiency. How much does it cost them to get all this incredible growth? Well, the customer acquisition cost, or CAC, payback period, tells us exactly that. For CrowdStrike, it's 29 months. What that means is for every new dollar they spend on sales and marketing, they earn it back in subscription fees in just under 2.5 years. In the SaaS world, believe me, anything under 36 months is considered good. 29 months is incredibly efficient. It just proves their whole go-to-market strategy is working like a charm and that their brand has real pull in the market. Okay, I have to give them this one. A 29-month payback period is without a doubt efficient. It means their sales and marketing engine is a very well-oiled machine. My only question, my only pushback here is this: can they keep that up? As you get bigger and bigger, all the low-hanging fruit is gone. It gets more and more expensive to find new customers who haven't already heard of you. So while this is a strong pillar today, we need to keep a very close eye on it for any signs of fatigue as they continue to scale. It's a point of strength, for sure, but it's also a potential point of future stress. That's a fair point. A strong foundation is absolutely critical. But a fortress isn't just a bunker you hide in. It has to be able to expand, to build higher. So let's shift gears from the foundation to the financial scaffolding. What's the framework that CrowdStrike is putting in place right now to support future growth? What are the engines that are going to drive this company from a $5 billion ARR business to $10 billion and even beyond? And this image illustrates their core strategy perfectly. It all comes back to one thing: the agentic security platform. You have to understand, the cybersecurity market is unbelievably fragmented. Most big companies are suffering from what we call vendor fatigue. They're trying to stitch together dozens of different little solutions from different companies. It's messy, it's inefficient, and it leaves huge security gaps. CrowdStrike's entire reason for being is platform consolidation. They've built the single AI-native platform that does everything from endpoint security to cloud security to identity protection. The strategy is so simple: land a customer with just one module and then expand, expand, expand. This platform is their #1 engine for growth, and it's their single biggest competitive moat. And they're not just sitting still. They are reinforcing this engine on 3 different fronts at the same time. 1, they're going deeper and deeper on AI with products like Falcon AI, which is absolutely critical in a world where the bad guys are also using AI. 2, they are forging massive strategic partnerships. These deals with giants like Microsoft and Aramco, they aren't just new sales channels, they are deep technical integrations that put CrowdStrike right at the heart of the enterprise ecosystem. This dramatically lowers their customer acquisition cost, and it validates their technology at the highest possible level. And 3, to complete the picture, they're making really smart, targeted acquisitions of key technologies like SGNL and Seraphic. This lets them bolt brand new capabilities onto their platform, which they can then immediately turn around and cross-sell to their massive existing customer base. It's a really powerful, multi-pronged approach to keep that growth engine humming. And, you know, that all sounds great. It's a really compelling story. But here's the first potential crack in the armor. Despite these really strong results and this powerful growth strategy, the very people whose entire job is to model this stuff, the sell-side analysts, they are projecting a slowdown. They see revenue growth decelerating to under 22% over the next year. Now look, 22% growth is nothing to sneeze at, but it is a noticeable slowdown from where they've been. And for a stock that is trading at a nosebleed valuation, even a tiny deceleration can be a huge problem. The market is pricing this thing for perfection, not for a slowdown. This is a major risk, and we have to quantify it. You are absolutely right. A qualitative debate just talking about a slowdown isn't good enough. We have to move from opinion to a quantitative risk assessment. So for this part, we're bringing in some heavy artillery, third-party AI-driven analysis. We're going to look at the actual probabilities of different outcomes and the specific trigger conditions that investors need to be watching for. It's time to put some real numbers on the bull and the bear scenarios. Okay, let's break this down piece by piece. According to Intellectia's AI model, there was a 45% chance, so basically a coin flip, of a standard beat scenario. And that's pretty much exactly what we got. Revenue came in around where we expected, EPS beat by a little bit, and you got that 5 to 7% pop in the stock. That was the most likely path. But just look at the tails of this distribution. There was a 1 in 4 chance of what they call a strong beat, which is where the stock could have really jumped. We're talking 10, 15% or more. And the trigger for that? It was all about net new ARR, coming in above $330 million. That one number is what separates a good quarter from a truly great one. Exactly. And on the downside, the key trigger for a miss was that net new ARR figure dropping below $290 million. If that had happened, the model predicted a 5 to 8% drop in the stock, as all those fears about AI competition would have come roaring back. So the crucial point here is that it all comes down to that net new ARR number and the forward guidance. That is the battleground. The actual result fell squarely in that beat territory, which explains why the market had a positive, but not totally explosive reaction. And this is exactly why, despite all those fears of a slowdown, the bulls are still so confident. The analyst consensus, which is reflected right here in this AI report summary, is that the company's leadership position in AI creates a truly defensible moat. I mean, products like Falcon Flex are reportedly seeing triple-digit growth. So the argument is that CrowdStrike isn't just another security vendor, it's a foundational AI company. And in a world that's being completely reshaped by artificial intelligence, that leadership position, they argue, justifies the premium valuation and provides a pretty strong buffer against the competition. This is the absolute core of the bull case. So, we have reviewed the blueprint, we have stress-tested the foundation, and we have inspected the scaffolding for future growth. We've even quantified the risks and the probabilities. Now, it is time to put it all together. It's time for the final inspection. It is time for the iron verdict. All right, let's lay it all out on the table. On one side, the bull case is frankly undeniable. This company looks like a financial fortress. They are generating record levels of cash flow. They have what is arguably the most dominant AI-native platform in the entire space. They've leveraged that into some incredibly powerful partnerships, and they've issued very strong guidance for fiscal year 2027. The structure looks as solid as a rock. But you ignore the visible cracks in that fortress at your own peril. The bear case is staring us right in the face. Revenue growth, while it's still strong, is undeniably decelerating. The valuation is priced for absolute perfection, leaving zero room for error. We're talking about a company trading at a forward price-to-sales ratio that is miles above the sector average. Competition in cybersecurity from giants like Microsoft and Palo Alto Networks is absolutely brutal, and there is always execution risk when you're trying to stitch together multiple acquisitions. You are paying a huge premium here, and you're basically betting that none of these little cracks will ever get wider. So this is where we have to leave you. Our stress test confirms it. CrowdStrike's financial structure is strong. The foundation is solid. The growth engines are powerful. But the price tag to own a piece of this company is incredibly high. You're essentially buying the best house in the best neighborhood, and you are paying a massive premium for it. So the final question isn't really about the quality of the company. It's about the price of the stock. And for your portfolio, you have to decide, are you willing to pay that premium to own the fortress? That is the calculated decision every single investor has to make for themselves. Our stress test shows the structure is sound. The price you pay is the risk. You have to weigh that balance carefully. This is Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.